Everybody, and welcome to our series on changes in accounting estimates and errors. And we're going to go ahead and look at a sample question. So my disclaimer and copyright notice is that the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. This presentation is for educational purposes only, can also be used to help you go to sleep, and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make reference to publicly available information that is the copyright of other parties. So let's go ahead and take a look at our sample question, and we'll go ahead and do this on a Google Sheet. So on December 31st, 2024, before the books were closed, the management and accountants of Maverick Inc. made the following determinations about two pieces of equipment. Equipment X was purchased on April 1st, 2022 for $360,000. The equipment is depreciated on a straight line basis over 5 years with no salvage value. On December 31st, 2024, we determined the equipment, wow, good job, Bennett. Equipment would last, by the way, always run spell check. I'm terrible at that. Will last for 4 years beginning on January 1st, 2024 with no salvage value. Okay, so the first thing we know with this is that this is a change of estimate. Okay, so this is going to be a change of accounting, change of estimate. Therefore, we're going to change of accounting estimate, handle prospectively. Okay, so that's what we're going to handle with this. So we're going to go ahead and then basically compute depreciation expense up until that date, and then we're going to go ahead and apply the new information going forward. Equipment Y was purchased for $1,080,000 on January 1st, 2021, and was erroneously error expense during that year, debiting depreciation expense, crediting equipment for the full amount. The equipment should have been depreciated over 10 years with zero salvage value using straight line depreciation. One thing I want to say really quickly, if you're taking my class with these types of questions, I'm not going to make you go through and do double declining balance. One other thing I also want to say too is that if you ever have an instructor that's trying to teach you some of the year's digits, that's a bunch of malarkey. If it's on the CPA exam, make sure to remove it. I once spoke with an SEC examiner many years ago, and I was at one of these conferences. I love to go up and ask them questions. And so the question I went through and asked was like, well, have you ever seen some of the year's digits? And he paused and he said, well, this guy was reviewed thousands of filings. He says like a few times, but they don't call it that. So there you go. It's an academic fund. So this is going to be an error, and we're going to have to go through and restate. Okay. Now we're given some information here is that prepare all the necessary entries in 2024 to record these determinations, including the correcting entry required for equipment Y. And then we're going to prepare comparative retained earnings statements for MI for 2023 and 2024. The company had retained earnings of $7 million at December 31st, 2022. Okay. Let's do the easy one first. Let's go through and look at equipment X was purchased on Ford 122 for $360,000. Okay, so the equipment was depreciated on a straight line basis over 5 years with no salvage value. So when we look at the formula for this, it's acquisition cost minus salvage value divided by estimated useful life. That is what we are doing for straight line depreciation expense. So coming over here, essentially the company was going through and taking basically $72,000 of this is be my annual depreciation expense. Now, when I look at how depreciation expense is being reported, right? So when I record depreciation expense, I'm debiting depreciation expense, and I'm going to be crediting AD. I'll call this equipment X. Okay, so in 2021, how much depreciation would I have taken? Well, when we look at this here, we have to always, the dates always matter, right? So when I looked at like an episode of The Bachelor, the dates are very important. So right here, if my annual depreciation expense was 72,000, then my depreciation basically over here during 2022 is going to be 72,000 times 9/12, or basically April through December. Okay, so for during 2022, we went through and recorded 54,000 of depreciation. Remember, I'm using this new information, basically would last for 4 years, beginning on 1/1/24. So I need to compute how much depreciation did I take to date. So in 2023, I would have taken the full year of 72,000. And if we just take a look here at our asset or equipment X, okay, so I bought this thing for 360. I've done this depreciation. So over here, right, basically, so my net book value as of 1/1/24 is going to be equipment X less the accumulated depreciation is going to be the net book value, not the National Broadcasting Company, but over here is going to be our net book value. Okay, so over here, prior to the change of estimate, right? And it's a change of estimate. My net book value for this equipment is going to be 234,000. Okay, so we know that. Now we're going to go through and use the new information to depreciate the asset moving forward. So coming over here, again, we're going to take 234, which is basically the remaining amount that we can go through and depreciate. And over here, we determine that the equipment will last for 4 years, beginning on 1/1/24. So over here, the amount of depreciation expense I'm going to go through and record for 2024 is going to be 58,500. So on 12/31/24, depreciation expense equipment X is going to be 58,500. And then I'm going to be crediting accumulated depreciation equipment X for 58,500. That would be my journal entry basically for this particular one. Okay. Now let's take a look at this next one over here. So over here, we've got something that's happening over multiple periods. Okay, so we've got over here, we've got equipment Y was purchased for $1,080,000 on 1/1/21 and was erroneously expensed during that year for the full amount. Okay, the equipment should have been depreciated over 10 years with zero salvage value using straight line depreciation. Okay, so when I go through and I look at this, I've got 2021, 2022, 2023, and 2024. In 2021, I took a hit basically to the depreciation expense. Like this is my error. Right, was basically $1,080,000. Okay, that was my error. The correct amount basically should have been at 108, basically $1,080,000 divided by 10 or 108,000. And I should have gone through and basically have done this basically for each, essentially for every single one of these years, right? So, okay. when I go through and look at this, I probably want what we can basically impact this in a few different ways. If I'm being though asked to do this for 2024, what exactly is this going to look like? Let's do the easy part first. Well, the easy part first, I would go through and say is that 12/31/24. I will do the hard part first. Okay, so what should this really look like? Well, we should have equipment Y should be at 1,080,000, right? I should have equipment Y should be 1,080,000. And then basically over here, my accumulated depreciation should be basically 2021, 2022, and then 2023. I should have gone through and taken 108,000 every single year. Okay, so coming to 12/31/24, right, the true value basically of this asset really is going to be equipment Y less your accumulated depreciation. So really this equipment as of 1/1/24, this thing should be on my books for 756,000. That's what should be on my books as of 1/1/24. So how am I going to go through and figure this out? Well, this over here, when I go through and if we really look at this, at this point in time, right, that I've got 108,000, I basically should have taken 324,000 worth of expense. But here I've effectively overstated my expenses by 756,000 because over the period of time, I should have taken 324, but I took 756. Now, this question is really important is it basically says we are going to ignore income tax effects. This is really, really important. So right over here for 2024 relating to equipment Y, the first entry I would go through and make is let's bring this equipment back to life. So we'll go ahead and do this as of 1/1/24. We'll basically say beginning, we'll say equipment Y at 1,080,000. Then we will go through and say accumulated equipment depreciation, equipment Y that's not Ernst & Young, or 324,000. And so now I'm basically bringing this back to life. I'm then going to have over here retained earnings over here because my retained earnings was effectively understated by 756,000 because I took too much expense. So this is effectively going to be to restore the equipment. Okay. Now I then need to depreciate the equipment. So as of 12/31/24, depreciation expense, equipment Y is going to be 108,000. Okay, now you might be asking, well, Bennett, why are you doing this separately? Because the 108,000 is the depreciation expense for the current period, right? I don't want to include any type of errors. This is hitting all balance sheet accounts, right? So by doing this, I'm restoring the equipment. And over here, I'm now going to basically record basically the depreciation. Okay, so basically to record depreciation expense, equipment Y. Okay, so let's again go ahead and take a look at these two examples. So what we're being asked to do is we're being asked to go through and prepare the entries in 2024 to record these determinations, including the correcting entry required for equipment Y. So over here, right? So equipment X, we basically handled this prospectively. We depreciated the asset up until the date of the change, applied the new information. We got that book value up to the date of change, and this is going to be our new depreciation expense, which is going to be right over here at 58,500. Why is this? Oh, that's right. So basically over here, this is going to be 58,500. That's to record depreciation expense for equipment X. Okay, now for equipment Y, because we're asked to do this as a 1/1/24 and not 1/1/23, we have to basically restore the equipment, right? So we should have never have written this thing off. Rather, we have to record the equipment and the related accumulated depreciation. This is what it should look like on January 1st, 2024. And again, these are all balance sheet counts because again, I can't record any current period income or any period kind of income or basic statement on this. Okay. Or any kind of current period. What's what I'm looking for? I can't record any type of I cannot go through and record a expense related to 2021, 2022, or 2023 and 2024. I'm limited just to going through and doing this. So this is how I would go through and do this over here. Now, if I had the books open, say for 2 periods, I would probably have done, we'll have to do this in this next part, but I would be going through and then saying, well, to restore it as of 1/1/23, then I would be doing just these two parts right. Okay, so that's where we are. We've done this. Prepare all necessary entries in 2024 to record these determinations, including the correcting entry required for equipment Y. Now we're going to prepare comparative retained earnings statements for MI for 2023 and 2024. The company had retained earnings of $7 million at December 31st, 2022. But what we also know is that we had income before any depreciation was 5 million. Income in 2023 was reported at 6 million. Okay, so let's go ahead and take this on. So give ourselves a little bit more room. Okay. Okay, so when we're looking at our statement of retained earnings, it's beginning retained earnings, right? So basically plus or minus prior adjustments. And then over here, we're going to basically have retained earnings as adjusted. Then we're going to be adding in net income. And then we also are going to be including in here the impact of the depreciation expense. Okay, so because we haven't, well, we'll get to that in just a moment. So we have net income, then we're going to have less dividends, and this is going to give us our ending retained earnings. Okay, so for 2023, okay, so my beginning retained earnings is going to be the ending balance from the prior period, which is going to be 7 million. Okay, now what are going to be my prior adjustments? Again, I'm not taking into effect the tax considerations. Well, as of basically during 2023, the adjustment is not going to be 756 because this was what we did as of 2024. So as of 2023, the adjustments we would have made is that saying, well, what would be the adjustment to retained earnings? Well, we would need to adjust our retained earnings effectively to increase it by 864,000. So if you want to make this a little bit cleaner, okay. So over here, we need to increase our retained earnings by 864,000 because when we're doing this for 2023, we're focused on, well, how much do we need to adjust retained earnings by? Well, we made the mistake initially of writing it all off, and we should have just had 2 years of depreciation. So effectively, our retained earnings is off by 864,000. So right over here, so my retained earnings as restated is going to be 7,864,000. Okay. Now, what is my net income? Well, it told me over here that my net income in 2023 was reported at 6 million. Okay. However, basically for 2023, if I'm going through and showing this, for 2023, what I should have done is, because I needed to take another 108,000 worth of depreciation expense. Remember, for equipment X, I don't do anything because we are handling that prospectively. But because I made this error, I need to basically say less 2023 depreciation expense. This is going to give me my net income as adjusted of 5,892,000. Okay. Then from this, what I'm going to go ahead and do is I'm going to go ahead and I want to give myself just a little bit more room here for 2024. You'll understand why momentarily. Okay. So, okay. So my net income as adjusted less my dividends in 2023. This over here is going to be at 800,000. So my ending retained earnings is going to be my beginning retained earnings. Remember, we're ignoring tax effects. So I'm just going to basically go ahead and basically punch that in as 864,000. It's increasing this by this amount. So then my retained earnings as adjusted is right over here. I add my net income less my dividends. And this over here is going to give me 12,956,000. And just give me one moment. Okay, so that's my ending, my new retained earnings. And I'm also going to put up here as restated, okay, because I'm restating what I did previously on my financial statements. Okay, 2024, I'm not going to have that issue necessarily. Okay, so for 2024, my beginning retained earnings is going to be 12,956,000. There are no prior period adjustments because I dealt with this in the previous year. So my retained earnings as adjusted is going to be 12,956,000. But here for my net income is going to be a little bit different. So income in 2024 before depreciation expense was 5 million. So here my net income is going to be 5 million. And then here I'm going to have also, I need to do depreciation twice. I need to take it over here for the 108,000. Okay. And what I also need to do is the 24 depreciation, or the less, we'll call this less equipment Y depreciation, less equipment X depreciation. So here I'm going to be subtracting 58,500. So my net income as adjusted is going to be at 4,833,500. Then my cash dividends in 2024 were 400,000. So my ending retained earnings is going to be my beginning retained earnings plus my net income less my dividends, or giving me a total of 17,389,500. Okay, and obviously, like when I go through and do these questions, they're probably saying, "Really, Tchaikovsky, I gotta solve this that much quicker." That's great. I want to encourage you to kind of go through and to do it that way, but I try to go through and I'm intentionally going through and over explaining things. If there's ever, whenever I do make a video, if there's something you would like me to spend a little bit more time on, feel free to leave a comment below. I'm more than happy to kind of go through and explain what I attempted to do in these videos. So, but that is our solution for this particular question. We'll have one more question coming up. Thank you again for watching. Please remember to like and subscribe. Feel free to leave a comment below or send me an email to ibc30 to cpa@gmail.com. Have a great day.